Well, good afternoon and welcome to our High Rock weekly client webinar. If you want to skip over any part of this webcast, feel free to use the fast forward control on your screen. Otherwise, sit back and enjoy. Each week on this call, we try to talk about what we see developing in the global economy, in financial markets, and the world of wealth management, and how all of this impacts our decisions on the best courses of action for our and your investment strategies. I'm Scott Tomlinson, and joining us on the call today is my partner and colleague, Paul Tepsich, the founder of High Rock, our certified financial planning professional and wealth forecast specialist. Bianca Tomlinson has taken a short leave following the birth of her first child. We do expect her to be back in a part-time capacity beginning in September. Well, each week we record this webinar so those who can't join us live can tune in when it is more convenient. If you are a first-time listener and would like a little more information about our private client services and our disciplined investing strategy, we have a separate introductory webinar that will provide you with this. And all you need to do is visit the homepage on our website and click on the Introduction to High Rock Private Client button. As you all know, our priority is to manage risk first and foremost. And currently we believe that we are in a time where investing risk is high and rising. We want to make sure that despite this, our clients have no trouble sleeping at night. So we're doubly aware of the current investing climate and all the many risks that are currently in play. And after we talked about it on our last week's call, the saber rattling between Trump and North Korea's Kim created a big spike in volatility. Paul, any comments?
Well, that was certainly a shocker, and in fact, it was a week ago today when we had our call when the headlines came across that Trump started the saber rattling and sounded much like Kim Jong-un. Nonetheless, it appears that the rhetoric is abated a bit, and as we've seen yesterday and today, stocks have largely retraced back, and bonds have given up some of their flight to quality bid or benefit from that volatility. Well, there you go. And as you can see from this chart, it's 10-year U.S. Treasury in white has you saw the V-shaped on the far right of the screen, which really doesn't look very big, but those are roughly 10 basis point moves or more in the last week. And stocks did the same thing above. So at this stage, as you can see in the bottom part of the chart, the correlation between stocks and bonds is largely flat. So as we move higher, it's going to become less correlated than we would like to see, in fact. So we do keep an eye on this on a most certainly on a weekly basis, but intraday as well.
So, Paul, last week when stock prices moved, they gave out, the S&P 500 gave up about 1.5 percentage-wise, and the corresponding price increase in bonds wouldn't have been anywhere close to being enough to offset a move in stocks. So, anybody fully invested in stocks in a balanced portfolio, you're not getting the appropriate coverage for that downside risk that you have on stocks with the bonds that you own. So what do you think?
Well, that's a good point, and that's something we've been watching for a while. And that's if some of our all of our clients should have remembered this, but we actually sold out of a lot of our duration or longer government bonds back in September 2016, so almost a year ago, because the correlation was starting to break down, and they really weren't going to. Our view was they weren't going to provide the same sort of traditional hedge to our riskier parts of the portfolio, like stocks. So we actually have lightened up over the past year a bit, and how do you combat or how do you fill that void of risk management in your portfolio? Well, we still utilize some government bonds. We utilize a lot of direct corporate bonds, both investment grade and high yield, and cash. And we're still sitting on roughly over 20% cash for most of our clients. So that's a defensive mechanism as well.
And Canadian bonds aren't really providing, in fact, they're providing worse coverage at the moment, aren't they?
Well, a little bit, but roughly the same. I think we're still feeling the effects of Bank of Canada governor comments that have come out over the past month or so. But that seems to have abated a little bit.
So I read on the weekend, I guess a competing portfolio manager's take on where to position bonds if the Bank of Canada continues to raise interest rates. And he suggested that owning shorter term bonds would be a better strategy. With our combined experience in this particular asset class, we'd like to think that it's not that case at all, really. In fact, history would suggest having longer term duration, wouldn't you think?
Well, in Canada especially, we have obviously seen some growth, but as you can see on the chart there, the white line is the Bank of Canada overnight rate, and that's when we talk about the bank or the Federal Reserve Board in the U.S., hiking up interest rates. We're talking about them hiking up overnight rates, and that is the rate that effectively they suggest other banks lend to each other at. In Canada's case, it's the Bank of Canada lending to the other banks. And the yellow line is, I believe that's a 30-year Canada yield, and the green line is the 2-year Canada yield. So, in fact, typically what happens when the bank is raising interest rates, think about it, the closer you get to the overnight rate, the more rates are going to go up. And in Canada's case currently, and part of our thesis here is that the bank is, if they start raising rates further, will likely make a policy error in the face of no or very low inflation. And it's been that way for year after year after year since 2008's recession. People have been looking for inflation, and it just has not materialized. So that being the case, the bank can raise rates all they want. And historically, what you have, back in the 2005 period, 2006, when the bank was hiking rates aggressively into what became the Great Recession, as you can see, 2 years really moved higher in yield, and 30 years kind of went lower in yield over that period of time, as you can see in the middle circle of the red circle. So what we call that is, that's actually a bear market flattener. 30 years actually performed quite well, and we think the same thing may happen here. That green line in the far right circle may actually go up and through, or certainly up to the 30-year yield. You'll have a flat yield curve. So I don't think you want to be positioned in the very front end of the curve, and we have not, and we will not. Does that make any sense?
Yeah, absolutely, and that it's great, and history proves it out. But the other side of that argument too is that when the Bank of Canada is taking on a role as to try to preempt or even fight inflation, that gives longer term investors, especially longer term bond investors, that gives them a sense of comfort that they know they're not going to need to demand an extreme risk premium as long as inflation is under control. And I think that is basically what this shows us, is that without inflation, and we currently don't have inflation, or certainly not any significant inflation, as we are under target inflation right now, bond yields, longer term bond yields are not likely going to go up very much if the Bank of Canada is seen as fighting even the little bit of inflation that we do have.
Yeah, that's a great point, Scott. And the enemy of government bonds is inflation. It erodes your purchasing power or your total return on the bond. And the further out you go in the yield curve, out towards 30 years, which is effectively as long as the yield curve goes for all intents and purposes, the more inflation or lack of inflation affects the yield or price of that 30-year government bond. So with very little inflation on the horizon, and the bank talking about battling against that inflation, that should actually help support the 30-year yield, in fact. So yeah, that's all part of it.
Yeah. Okay. Great. No, I just think that's a good point of discussion, and interesting how, with all of our years and experience in bonds, that you can get differing opinions out there, but I like to think that we have a pretty good understanding of what's going on in that world.
I think so.
We've been monitoring the Canadian dollar recently because of a very significant move higher in the Canadian dollar in relative terms to the US dollar. Lately, we're starting to see that turn around a little bit. Paul, you've been on a whole bunch of conference calls with regards to Canadian company earnings over the last week or so, or even a couple of weeks. But give us your take on what you're hearing about CEO and CFO thoughts on where the what's going on with the Canadian dollar and what that impact might have on their particular companies.
Yeah, that's a good point. So, and I think I mentioned this the last few weeks. The currency has rallied roughly 10% since May, and that's a big move and over a very short period of time. So on the ground, I'll give you a couple examples. I've been on a few forestry company calls. So companies report financial numbers every quarter and hold conference calls for institutional investors like HighRock and equity analysts at the banks and dealers. Retail investors or investment advisors can't call in and participate in the calls, but we do get access to that. And I can tell you that a lot of CEOs and CFOs in the forestry sector are quite concerned in that sector, specifically about two things. Number one, the rapid improvement in the Canadian dollar. This obviously hurts exports down into the U.S. specifically, and even into China and Japan, which are big buyers. Japan's a big buyer of timber from Canada. Now, some of these forestry companies are obviously concerned about NAFTA and the countervailing trade duties that have come into play or will come into play in the forestry sector in Canada. Also, some of the energy companies, so some of the oil and gas exploration and producing companies have an issue because a lot of their costs, if they're strictly drilling in Canada, are in Canadian dollars. So up until May, they were looking pretty handsome. So, they were all their costs are in Canadian dollars weak, and they're selling oil or gas in US dollars and able to sell that and repatriate back into Canadian dollars. So that now has changed dramatically over the past 3 months. And I think we've seen a bit of that effect on some of the stocks in Canada. These energy stocks in Canada continue to get hit because of that. So again, some of these CEOs have mentioned the appreciation in the Canadian dollar as being rather rapid and severe for them. Very hard for a company like that to adjust that quickly. Now, a lot of them don't have specific hedges in the currency on.
Well, that's one impact of the stronger Canadian dollar on the Canadian economy, and obviously that will have some repercussions going forward. Another impact of the stronger Canadian dollar, as we started talking about a little bit last week, is the impact on a fully invested 60% equity, 40% fixed income portfolio with a global equity exposure. So as our clients know, we use the All Country World Equity Index as a comparison for against our global equity portfolio, our global equity model, I should say. And we also use the Canadian Bond Index ETF as a proxy for the performance of the bond market in a 60-40 balanced portfolio. And one of the things that we've seen is that even when you get, as we have had over the course of the last year, a fairly significant move in upward in equities, it's been negated to a good degree by that recent move in the Canadian dollar, as well as negated by the 1-year performance of Canadian bonds. And all told now, that balanced portfolio after fees is only up a little over 6% on the year. But even more importantly, over a 2-year average, we're seeing only about just a little under 3.75 annualized return on that 60-40 fully invested portfolio. So investors who look at the stock market and just say, oh, wow, the US stock market's up so much, why isn't my portfolio? Well, there's a good reason. A balanced portfolio with bonds doing what they're doing and the Canadian dollar doing what it has done has really taken a good bite out of portfolio performance over the last couple of years. Well, that's one reason we like to have a more tactical approach to investing. It certainly allows us not to depend on some of those old correlations that we think are becoming less reliable and do not appear to be providing what we would consider portfolio balance that offsets risk. And as risk is rising, we obviously want to make sure that we're doing everything we can to keep risk as low as possible. So we do remind everyone, as we do each week, that historical returns are no guarantee of future returns. But as you know, at High Rock, we do work very hard to provide our clients with the best possible risk-adjusted returns. We also believe that it is extremely important that we review your wealth forecast on a regular basis with you so that we can ensure that your long-term goals are still in line with your portfolio strategy and that our forecasts for your net worth into the future are up to date and heading in the right direction. If you would like to review any aspect of your portfolio or wealth forecast, please do not hesitate to reach out to us. Each week we point out our key themes for 2017, avoiding risk when risk is high, and we think that at the moment, as I've said often enough, risk is very high. It means being more tactical inside an investment portfolio. Price stability is a mandate for all central banks, and the level of inflation or expected inflation is a key determinant for central bank policy. The Bank of Canada has raised rates a few weeks back. The U.S. Federal Reserve has raised rates by 0.75 percentage point since December and is now expected that they may raise them at least one more time this year. And rising borrowing costs and reduced financial system liquidity may increase volatility as we move forward. Stock prices and valuations are close to their highs, but without more significant earnings growth, this leaves them vulnerable to correction. Economic growth does not appear to be supporting current valuations, and the Trump agenda has so far failed to bring a new healthcare option, and it has impeded progress on fiscal stimulus. There's Brexit negotiations, and this week we're starting to see NAFTA renegotiation. There's been tensions with North Korea, Russia, and the Middle East, as well as global cyber attacks and terrorist threats, all adding to the blend of political uncertainty that confronts us on an ongoing basis. Well, the evolving inflation story is one of our important themes for 2017 as we try to assess the implications for central bank monetary policy and interest rates. If economies are growing, inflation should be growing, but at this moment, we do not see that happening, especially from the inflation perspective. All central banks do have a mandate to maintain price stability. Interest rates and monetary policy are used to keep inflation at targets of about 2%. Currently, only the Bank of England is dealing with inflation above that level, but they are also dealing with Brexit and an economy that has stalled. In the US, consumer prices have only grown at a rate of 1.7% over the last year through July. It certainly is a concern when inflation is below target, economic growth is only moderate, and the central bank is tightening monetary policy. Paul, we've talked about Bank of Canada potentially making a policy error. I think the same goes for the Federal Reserve, correct?
Yeah, that's part of our view as well. And but they certainly, I don't know, maybe over the past, say for yesterday, which drove a bit of a sell-off in the government bond market in the U.S., when William Dudley, the president of the New York Fed, spoke and said the market is mispricing or miscalculating the Fed's willingness to hike rates. Save for that, the rhetoric has sort of died down a little bit. But yeah, same thing. We think the Fed's going to make a policy error here by hiking prematurely in the face of very low inflation.
And as we've mentioned before, that will, in all likelihood, flatten the yield curve and potentially drive us closer to a potential recession.
It might.
We're also paying close attention to the global debt situation and borrowers' ability to service that debt when the interest rates move higher. That becomes certainly a bigger issue. Global debt is at record high levels, again in the US, and also a recent report from the International Monetary Fund suggested that China's increasing debt burden could be a significant risk if an economic shock like a trade war were to occur. So the IMF has warned on China's current and potentially future debt levels. Paul, do you have any comment on the Chinese situation?
Not China specifically, but I was just going to mention that part of our view on a slightly more positive strategy with government bonds is that there is so much structural debt around the globe that, quite simply, interest rates or government bond rates, yields, just can't go up that much. It's just like if you were a household straddled with a ton of debt, it's very hard to grow. It's very hard to these governments now are in such a dire fiscal situation that they can't go out, and they've done all they can on monetary policy. They've eased rates down to zero since the recession. They've gone out and done quantitative easing and bloated out their balance sheets on the central banks, and technically that's infinite. But on the fiscal, that's monetary policy. On the fiscal side, these governments are really handcuffed because they are so indebted. As I said, there's so much structural debt. So it's very hard to get the economy moving to a more normalized pace of growth and to see inflation. I just don't see how rates can really climb up substantially from here.
And that also brings up that issue that if we do get an economic turndown and there is such significant amounts of outstanding debt, how do they begin to counter that situation? Because, as you said, governments are their hands are tied. They don't have a whole lot of room.
Well, they won't. I mean, it'll be left up to the central banks again.
Yeah.
And I think that's part of what these few central banks, the U.S., Canada, England, ECB, want to do is, raise the overnight rate a few times so they can get up there in case they need to drop it down again, because governments will not be there to offer fiscal policy stimulus.
Yeah. And that's why the Fed certainly wants to get its balance sheet as low as they possibly can in case they have to come back and start buying debt again.
Yeah, they probably won't get any done by the time we get another turn down.
There you go. Well, this is no surprise. We think stocks are expensive, especially in the U.S. Earnings are expected to grow at a rate of about 6.5% over the next year, including that growth expectation of 6.5%. The forward price to earnings ratio is already 24% above its 10-year average. That's a long way back to the mean, and we know that eventually everything does revert back to the mean, in which case we don't want to be investing in U.S. stocks at this particular point. Enterprise value to EBITDA, another one of the metrics that we follow, is still as expensive as it was at the time of the dot-com bubble. So again, just another reason that we're steering clear for the time being of U.S. equities. On the geopolitical front, well, the Trump administration continues to struggle to move its agenda forward, and it looks like North Korea decided not to teach the U.S. a lesson just yet, but Pyongyang is an expert at rapidly escalating and de-escalating tensions, and the next cycle could begin as early as next week when American forces begin their annual joint exercises with South Korea.
Now, did you Photoshop that picture, or was that professionally done?
I would like to say that that was all my idea, but alas, no. As a victim of the internet, I come across these things from time to time, and it actually looks pretty good on both of them. Anyway, here at High Rock, we do continue to work hard to get the best we can for portfolio growth for our clients, but we are definitely uncomfortable with risk at such high levels. We think the U.S. economic cycle is in its late stages, and there are signs that certainly make us uncomfortable, as we've discussed today. We don't want to have too much risk in our models and in our portfolios. We all know that we work too hard for our money, and we want to make sure that we remain prudent about it.
Hey, Scott, maybe we should just add on that slide too, just a couple very small, well, one of them is big, a couple portfolio additions. So first of all, I initiated a position which we're still working through on a Canadian company that I was invested in myself about 8-9 years ago, and I've been looking at it again for the past 6 weeks or so and started initiating a position in that. And the other thing we should go back and mention, and I referred to it when we were talking about the Canadian dollar, we did 3 or 4 weeks ago buy US dollars against Canada. And quite frankly, we see that as an investment. We see that as passive risk management in our portfolio. And it is our biggest position for all of our clients right now, is being long US dollars and short Canadian dollars. So that's our most significant investment at this stage.
And that that trade that we did a few weeks back is up a nice almost 2.5%, I think.
Yeah, that's right. And most of our clients should be sitting at around 15% weight in US dollars right now. So that is helping our cause.
Excellent. All right. Well, as always, we want to thank you for taking the time out of your busy schedules to listen in. We have been trying to make this webinar more of a dialogue, focusing on some of the topics that we think are important and worthy. Anytime you have any ideas of anything that you might want us to discuss, we would certainly feel free. And we have received some good feedback, all of it positive, so we're very appreciative for that. But there may be some ideas that people have of different things they want to hear us talking about. So we're always wide open to suggestions. This is going to be our last webinar until September. We're going to be still around, but we know that a lot of people take vacation during August. I know Paul's going to be doing a bit of traveling, and in fact, I'm going to be doing a bit of traveling to the East Coast, doing the Canada 150, our little bit of Canada, do Canada 150. So looking forward to some adventures in Prince Edward Island. Although we are always available 24/7, and you know how to get a hold of us if you need us. Anyway, we'll be back in September. Until then, this is Scott Tomlinson, and on behalf of my colleagues Paul and Bianca, I want to wish you all a great rest of the week and a terrific weekend.